Hey everyone, it's Kyan again. I have a quick question for you. When you're looking at your portfolio right now, do you have a clear macro framework that actually tells you where the markets are heading next? Or are you kind of just making your investments and having best guess assumptions and hoping that it all works out? Well, if what I describe really does sound like you, you're definitely not alone because 95% of most retail investors are doing the exact same thing. And it's not because you're not smart, and it's definitely not because you're not intelligent. It's because no one's ever shown you how to read the three most important macro signals that professional investors use every single month to monitor what's coming next. No guesswork, no hope. I'm literally talking about the same macro data that central banks use to set monetary policy. And this is the same data that investors use to predict the stock market's next move. And you got to remember, central banks must control economic growth, all right? And it's economic growth that drives corporate earnings. And it's earnings that drive the valuation of the stock markets. So once you have these three principles in place that I'm going to cover with you today, you're going to have a powerful framework that positions you with elite investors. But first, here's the thing that I want to talk about. You've done the hard part first. You've built the income, you created the capital, and you've got your money in the markets working for you. Congratulations. You've done the first thing that 95% of the rest of the population don't ever do, okay? But every time there's a pullback in price, every time there's a interest rate decision, or there's a piece of economic data that comes out, okay? Some news that flashes the headlines and it jolts the markets. I know you feel it. That emotional uncertainty. That moment where you think, shit, should I hold? Should I sell? Is this the beginning of a bigger macro trend? Is the oil price going to crash the markets? Are earnings going to keep going up? Like, what is the situation right now and where we're going? And that problem is an uneasy feeling that doesn't sit right with you. And remember, the problem isn't you. The problem is that no one's ever taught you how to read the macro forces that are really driving the markets. Now, over the years, I've educated hundreds of traders on the exact framework that I'm going to be sharing with you in this video. And as soon as they learn how to implement a macro framework, it removed all the guesswork, all of the emotional trading and investing, and put a clear, rules-based, systematic way of thinking into their investments, and it completely transformed the way they looked at the markets. Now, before we get into the three most important macro indicators that every professional investor closely monitors each and every month, you need to understand one thing. The stock markets are forward-looking. They don't price in what's happening today. They price in what's expected to happen in the future, specifically earnings growth, revenue growth, and profit expectations. But the bigger picture is the macroeconomic environment those profits are being generated in. So when you understand what the economy is expected to do over the next 6 to 12 months, you'll understand where stock valuations are likely to go. And this is the game professional investors are playing. And the good news is the macro data that tells you this story is publicly available every single month. You just need to know where to look for it. So with that said, there are three main macro data trends that professional investors follow every single month consistently. And together, these three indicators predict GDP growth, and by extension, the stock market returns with an 85% certainty. Okay, so let me break down each indicator in a bit more detail. So the first is business surveys. So think about it this way. Before the economy either expands or contracts, businesses, they feel it first because they see in real time orders change. Okay, they see in real time how much production should be increased or decreased based on those changes in orders, and that affects their hiring decisions. Do they increase employment or decrease employment based on their earnings expectations? So this directly affects the confidence of businesses moving forward, and the survey tells us if business confidence is rising or falling. And we can capture this twice a month in the two surveys that get released. And these two surveys are And then in this example, we're going to look at the United States, but every country releases these reports. It is the manufacturing PMI and the services PMI. And for our US example, that's called the ISM, the Institute of Management Manufacturing PMI report on business. And then we have the Institute of Supply Management Services report on business. Okay, and these two surveys have an extraordinary track record, and not just in the United States, all around the world. So when these surveys are rising above a specific number, this is basically the purchasing managers at the biggest manufacturing companies and service-based companies telling the markets that they're expecting their earnings to grow. And this is when investors are confident about the future prospects of economic growth and corporate earnings. So they're very committed to buying the stock markets when these surveys are positive. Now, when the services data or the manufacturing are going beneath a specific number, again, this is an indication directly from the purchasing managers of the biggest manufacturing and services companies in the United States and for other countries in their specific country, okay? Or if you're looking at Europe, the whole entire region, again, this is telling investors that when it's beneath a specific number, the earnings expectations are being revised down. So they're giving warning signs to the markets to say, hey, our earnings are expected to decline. So these two data points have an unbelievable track record of predicting GDP growth over the next 6 to 12 months with an 85% certainty. And when we look at the manufacturing and services PMI data in a second, this data goes back to 1948 and it's unbelievably accurate. So professional investors are watching these numbers closely like a hawk the moment they are released. Okay, and you got to remember, not because anyone's guessing, but because they're reading the future expectations of economic growth and corporate earnings directly from the mouths of the biggest companies in the United States. Okay, so when we look at this image, we can see, all right, the orange line is the manufacturing number, the survey being released each and every month. And you can see it on the left-hand axis of this chart. Now, the blue line is actually the S&P 500 annual returns in percentages, okay, each and every month when the data comes out. Now, notice a trend. Look how closely correlated these two data reports are. So you can see when the orange line is going lower, indicating earnings expectations for companies are going lower, the stock market is going lower. So the annual returns of the stock market may be now going to -5, -10, -20% as the surveys are getting negative and more negative. But as soon as the surveys start to pick up, so confidence starts to come back in the purchasing managers, look what happens. The stock markets start to rise. And if the surveys start to decline again, the stock markets decline. And when the surveys are rising again, investors are going into the markets and buying the stock markets. And then we could have maybe 20% returns in the stock market, 30% returns in the stock market. And look at this beautiful correlation. Look at the dance between the two numbers. Okay, because this is how investors know whether to be going into the manufacturing sector and buying the companies or selling the stocks of the companies, because the surveys are the only cleanest way to know directly from the horse's mouth what are their expectations for corporate earnings. And that's going to drive the value of the stock markets. So this is why you see the S&P 500 rising and falling with the survey. Okay, so this is so important to understand. And it's basically this data going above and beyond specific numbers, okay, and turning points in a sequence that you have to understand to be able to know how the stock markets are moving. And it's so powerful. And you have to remember, these are 400 of the biggest manufacturing companies in the United States. So these are real numbers. And this is going back to 2000. So we're looking at back at 26 years of data here, and you can see this beautiful correlation between stock market returns and the manufacturing data. Now remember, manufacturing makes up 20% of US companies. Okay, now if you have a look at the services PMI, this makes up 80% of US businesses. However, this survey only started in 2008, so there's less data, but it's still, again, if you look at it, unbelievably accurate. When the numbers are getting positive and more positive, the stock markets are booming. But as the numbers start to decline, maybe have a slowdown, you'll see that the stock markets can also go down a little bit. Now notice that the services sector has stayed above in a growth territory where you're seeing positive stock market returns from 2010 pretty much all the way until 2020 before we had the big COVID crash. The services sector was really driving US growth. We only had small dips here and here. Okay, so this is what was driving a lot of long-term growth in the United States. Now, this is asking 375 purchasing managers in the services sector, again, their expectation for their earnings. And this makes up 100% of businesses in the United States. So these are the two main surveys, okay, that investors are closely monitoring to know what to do with their money. And if you can understand how to interpret it, if you can understand the sequencing, the turning points, you have an incredible tool at your disposal to be able to invest in the markets with the elite investors by using macro data, which predicts the economy and therefore predicts the earnings of companies, because economic growth and corporate earnings are linked. They're tied together. If one goes up, the other goes up. If one goes down, the other goes down. So this is the powerful macro data that you must understand. So next up, we have consumer surveys. Extremely important for investors, and really one that most investors don't really understand and realize is extremely important, because consumer spending accounts for 70% of economic output. Simply put, if consumers are confident, they spend money. And if they spend money, the economy grows. And if the economy grows, then corporate revenues pick up and they start to grow. And if revenues are growing, then earnings are growing. And if earnings are growing, then stock prices are going to rise. And vice versa obviously applies if consumers lose confidence about their future economic prospects. If they cut spending, then revenue will slow, earnings will slow, the economy will slow, and stock prices will sell off. So investors watch two reports like a hawk every single month. The consumer survey reports that come out ask a series of questions, okay, to consumers, and they're going to ask them, what is your current state of confidence? How do you feel about the economy now? How do you feel about your job security? How do you feel about how things are looking in the present economy? And this is a very important indicator that's literally telling you from the mouths of consumers, are they optimistic or pessimistic about their financial future right now? Okay, so investors closely monitor this, extremely closely. And then there's something else investors are closely watching. In the same reports, they start to ask them, okay, so we understand how you feel now, but most importantly, how do you feel about your future economic prospects? Okay, and this is key, because if consumers don't feel confident about the future, they're going to start making decisions now about how they should behave or they should act. Okay, if someone feels extremely confident, they're going to get a pay rise, they're going to get a better promotion. They may go get that house that they want to buy. They may go and get that car that they want to buy. They may spend that money on that credit card with the confidence they can pay it off. Okay, and if the consumers feel like that maybe they're not sure about the job security, they're hearing things in the news about there could be a war in Iran and oil prices are going up and there's going to be high inflation. They're not feeling confident. They're not feeling sure. They're going to start to tighten their belt, save their money. And that can cause, again, corporate earnings to go down, revenues to decline, the economy to contract. And therefore, it's going to affect the stock market's performance. So investors are closely watching their current economic conditions, which is the consumer confidence, their expectations for how they're going to see the economy moving forward. And then the third question that investors are closely watching in a survey is inflation expectations. They ask consumers specifically, are you expecting inflation to rise or fall, and by what magnitude? Now, this is extremely important because, again, high inflation expectations above the market's 2% goal, or the central bank's 2% goal, on what the markets expect, and consumers, well, you have to think about it. If consumers expect inflationary pressures to really pick up, that basically means that unless their wages are keeping up with inflation, their purchasing power of their money is going down, so their living standards are dropping, and this can affect their confidence. Okay, this is why when COVID happened and the war in Ukraine happened, why central banks had to raise interest rates so aggressively to get inflation expectations, more important than anything, down. So consumers could have confidence that inflation would return. Because what you don't want happening is if consumers feel like inflation expectations are going to get out of control, right? And they feel like inflation is going to go up aggressively, they'll start demanding higher pay from their employees. They'll say to their employer, listen, if you don't pay me more, I'm going to go get a job somewhere else. And if their employers then have to raise their prices to offset having to raise wages to keep and maintain their best talent, this is called an inflationary spiral. And this is what central banks are scared of. This is what's happening in Argentina. This is what's happened in other major economies like Turkey, where they have inflation at 50, 60%. Okay, and that is out of control. And on the flip side, they don't want consumers to have that they don't want consumer confidence to fall so much that consumers maybe stop spending money. And if consumers expect prices to keep falling, maybe they'll just hold off from spending, thinking they'll get a better deal in a week or two. But that's going to really affect corporate earnings. That's going to really affect how much companies start laying off workers, and you might start to see mass unemployment levels because consumers may think prices are dropping because we're in a slowing economy. They're going to just save money for a bit longer and then buy what they want to purchase. But again, that could result in millions of people losing their jobs. So inflation expectations is very key because it's literally going to tell you what the consumer is thinking about the future and the knock-on effects that's going to have in the economy. So again, consumer confidence is key. Consumer expectations for their confidence is key. And then the actual level of inflation expectations is crucial to the markets. And it's actually this number, the inflation expectations, which the central banks are monitoring like a hawk, because they're going to change interest rates fast if they believe that consumers are expecting inflation to go above target or below target, because they need to anchor those expectations around 2% for the reasons that we just spoke about. All right. So very interesting, a very important report that investors are monitoring every single month. And as soon as the data comes out, they pick it up and they act on it immediately. And this is why consumer surveys move markets every single month. So here we can actually look and see how does the consumer survey data that comes out every month. And here we're looking at the University of Michigan survey in the United States. And then we're going to look at the returns of the stock market. So here is the report in the light green line. Okay. And on the right-hand axis is the University of Michigan report. And then on the left-hand axis is the S&P 500 annual yearly returns. And again, you can see as the line declines, showing consumer confidence is dropping, the S&P 500 starts to decline. And then as the confidence returns, you get positive S&P 500 returns. You can see the green lines in the background. And look, they literally move together because, again, consumer confidence is driving economic growth, and economic growth is tied to corporate earnings. And therefore, when markets are looking at the surveys of what consumers are telling them about their future economic prospects, how they feel now, what they feel about inflation, is going to drive their spending decisions. So investors use this survey to know when to buy and to sell the stock markets. Now, for each country, there are specific readings that equal a specific level of economic growth. And those readings are crucial to get this right. And here is a beautiful example of European consumer sentiment and European GDP growth. So we've gone outside of America, but look at that correlation. The red lines are quarterly GDP in Europe, okay? And the red lines and the light blue shaded area is the consumer confidence. And look at it. As consumer confidence starts to decline, look at GDP growth start to decline, get weaker and weaker and weaker. As soon as consumer confidence starts to return and gets higher and higher and higher, what do you think's happening? Spending's returning. And look, you get positive and better and higher economic growth. And then for whatever reason, consumer confidence drops. This is going into 2008. So this would have been the housing crisis. And then look, GDP growth tanks and turns negative. And then as it starts to return, GDP growth starts to return. So you can see the consumer's level of confidence, their sentiment about how they feel, about their future, about inflation is driving GDP growth. And if I was to tie this into another chart showing you the European stock market returns, it would look exactly like this, because GDP growth and corporate earnings are linked. Okay, it's not coincidental. So there we have it. Consumer surveys, so important to understand and monitor if we want to understand what's likely to move forward. So again, consumer confidence, consumer expectations about their future, how confident they feel over the next 6 to 12 months, and then inflation expectations. These are the keys that you have to understand to be able to predict the stock markets. Now let's get into the third piece. And this is the jigsaw that ties the entire picture together: bond yields, specifically the interest rate on a 10-year government treasury. This is known as a treasury yield. So here's how it works. When a professional investor decides what to pay for a stock today, they're essentially making a calculation. What are the company's future earnings worth in today's money? And to do this calculation, they use the 10-year bond yield, also known as the discount rate. All right, so how much do I pay today for the future earnings of a company? Well, if bond yields are rising, this basically means the present value of future earnings of a company is falling. Okay, and that will obviously translate into stock prices falling lower or repricing. All right, and when bond yields are falling, the present value of earnings are now rising, and stocks will look cheaper, money will flow in, and prices will rise. Now, this doesn't mean that if bond yields are going up, stocks are automatically going to decline. It's all about the rate of change, how fast bond yields are going up or down. Okay, so that's really important to understand. Now, here is what makes this so powerful. Bond yields don't just move randomly. They move because of economic growth and inflation expectations. And what surveys predict this? Well, we've already covered the main two surveys, all right? Business surveys and consumer surveys. When economic data is strong, bond yields will rise as economic growth and inflation expectations build. And when economic data weakens, well, we know what will happen. Bond yields will fall because the economic data is predicting that growth and inflation expectations are now starting to decline. So these three indicators, they're not separate signals. These are connected into a framework, the macro mechanic framework. The business surveys tell you where the economy is heading. The consumer surveys tell you if that direction is sustainable, and the bond yields tell you what professional investors are paying for stocks as a result. Okay, so now that you understand how these three key macro data releases come together, you'll stop emotionally reacting to the news headlines, and you'll now start learning how to use the macro data that's driving the prices in the stock markets. And that is literally the difference between guessing and predicting. That's the difference between being a retail investor and now you're becoming an elite macro investor. And if you really want to go further into learning macro mechanics, there are another 6 key economic data releases that complete this macro puzzle that is absolutely essential for you to learn. So I've put together a full training video on how to use the macro mechanic framework to invest with absolute confidence. And it covers everything: how to read the data, how to structure your thinking, and how to make decisions without the noise. So please head over to macromarkets.co.uk to enjoy your free training. Thank you so much for watching this video. Plenty more videos to come, and I'll see you soon. Thank you.